if you think about how you would explain something to a non-accountant. So, for example, let's take property, plant and equipment, let's say a building. If I'm trying to explain to a non-accountant how that number gets onto the financial statements for a building, I would probably say something like it's cost minus an amount which represents how much I've used up. So a non-accountant wouldn't understand depreciation, so we have to change the language. And we end up with, perhaps, as I've said, cost minus an amount which represents how much I've used up. So that would be a measurement. Now then, question for you, and what I'm looking for here is a show of hands. Okay? Let's say, for example, that I change from using straight line depreciation to using reducing balance depreciation. Okay? Put your hands up if you think that changes that measurement base, if it changes that definition. Okay, so put your hands up if you think it changes the measurement base. Okay, few hands going up there. Right, unfortunately, that's not the right answer, because if you remember, our measurement base was going to be cost minus an amount which represents how much I've used. However, what we're saying here is that that definition doesn't change. All that's changing is the way I'm estimating how much I've used. So using straight line depreciation or reducing balance depreciation, it's just a way of estimating how much I've used up. Okay? Try another one. Let's say that I shorten the useful life of that asset. So instead of depreciating it over 10 years, I depreciate it over 5 years. Okay? Now, is there anybody that thinks that is a change in measurement? Good, you're getting the hang of this now. Brilliant. Because that is not a change in measurement, because again, all it's doing is changing the way I've estimated the consumption of that economic benefit. So again, that would not be a change in measurement, that would also be a change in estimate. If I decided to revalue my asset, well, remember my definition was cost minus amounts which represent how much I've consumed. Well, now it's going to be revalued amount, less an amount which represents how much I've used, so that one would be a change in measurement. So a change in measurement is a change in accounting policy. Okay, or change in ACPOL, as I abbreviate. A change in estimate is no change in accounting policy. Okay, so a change in estimate is no change in accounting policy. A change in sort of measurement, okay, is a change in policy. So to recap very quickly, for a change in accounting policy to have occurred, we're looking for any one of a change in recognition, presentation, or measurement base. A change in estimation technique, that is not a change in accounting policy. Okay? So, we have a change in policy, we have a change in estimate. So, how do we deal with each of those? If we have a change in policy, then that will give rise to a prior period adjustment. A prior period adjustment is literally what it sounds like. We will go back and we will actually change last year's financial statements. So, for example, let's say that previously I had reported a gross profit margin, so gross profit divided by revenue, of 50%. Okay, so in 2007 I recorded a gross profit margin of 50%. If in 2008 I'm reporting a gross profit margin of 55%, then that looks good. Everyone's happy. Okay? For the simple reason that margins have increased and the business is therefore performing a lot better. But if it turns out that in actual fact the way that I have actually increased my gross profit margin is because there were some expenses which were previously included within sort of cost of sales, and I've now moved them down into distribution costs. Well, what we end up then is someone who's not very happy for the simple reason that that 55% is not genuine. Okay? Well, it is genuine in terms of the gross profit, but it's not comparable with the previous year. So therefore what we would do is in our gross profit margin for 2008 would stay at the 55%, but for 2007 we would restate and it might come out at 57%. So in reality, by restating 2007's figures, we may show that the gross profit margin is now 57, and so therefore it's actually gone from 57 down to 55%. Okay. Excellent. So that would constitute a change in accounting policy. Now, if you look in your notes on page 51, if you would please, where there's an illustration 1. Now, in illustration 1, it's saying that Multi commenced trading 2 years ago on the 1st of January 2006 and adopted the accounting policy then allowed by IAS 23 of recognising interest costs in profit or loss. So they've started off by expensing all of their interest costs. The financial statements of financial position, so effectively the balance sheet under the new name for it, is given to you below. Okay? And what they've decided to do now is to start recognising those borrowing costs as a cost of the asset. Okay? So as you can see, previously property, plant and equipment was 284 in 2007 and 241 in 2006. During 2007 they've now started capitalising those borrowing costs, and that has now increased the 2007 figures by 10, okay, which was the borrowing costs sort of during the year. So they've increased the assets by 10 million. But if you notice, 2006 has also been restated as if they had always been capitalising their borrowing costs. Excellent. So that's a change in accounting policy. A change in accounting estimate, the way that we deal with a change in estimate is that we actually treat it as a prospective change. A change in policy is a retrospective change, in other words we go back in time. A change in estimate is a prospective change, i.e. we're only moving forward. Now there are additional disclosures that you have to make. The disclosures that you would have to make in both cases is to show the impact of actually changing whatever you've done. So if I did change my depreciation rates from one year to the next, I would be required under IAS 8 to disclose the impact of that change. The difference being is because it's a change in estimate, I'll only be required to actually show the impact of that change in the current year. If it was a change in policy, I would need to show the change of the policy impact in the current year, but I would also have restated my previous year's figures as if I'd always been adopting that new version of the standard. So we get a change in policy when there is a new standard or an IAS 8 change. We have a change in estimate at any time, but we still have to justify it. And that change in estimate arises from wanting fairer presentation. So if I have sort of a property and I think that property is going to last for 30 years, however it's in a fairly rundown area, there's been maybe a fire, in that case I may need to shorten the useful life so that we're depreciating it that little bit quicker. There are impairment issues, and we'll talk about those this afternoon or later on today. However, at the moment we're just talking about the change in accounting policy. If it's a change in estimate and I am shortening the life of the asset, then we would recognise that and disclose it separately in the financial statements. So, prior period adjustments. What causes a prior period adjustment and a prior period error is again quite important. So what we're looking at here then is, if you remember, we had a sort of change in policy, and we said that comes from two places, either a new standard or what I referred to as an IAS 8 change. We also over here have the idea of errors. Now obviously if you know that there is an error in those financial statements, you would change it. Now that's fine if your error is in the current year, but if your error is actually relating to the previous year, that's going to be somewhat difficult. So if we have an error, that will also give rise to a prior period adjustment. However, we're not just referring here to all errors. Because if you were to go back and restate the financial statements for every single error that had been identified, you would never get round to producing this year's financial statements because you would constantly be going back and changing previous years. So what level of errors do we actually have to go back for? Well, what we're looking for here is anything that is material. Now, excuse me, the change due to material errors is causing an awful lot of problems for an awful lot of auditing companies. You see, in the past, we've only ever had to worry about prior errors are very significant. Now, however, we're actually recognising those errors when they are just material. And of course, materiality is documented all over last year's audit file, and so therefore there is an actual number to measure these errors against. So if in previous years I had been working to a materiality of, say, 50,000, then this year I find a mistake in last year's accounts of 51,000, then I would have to go back and amend those last year accounts. Now, obviously from an auditor's perspective and from management's perspective, it's kind of saying that last year's financial statements were wrong. Now, that's not really a good message to be giving out to shareholders. So this standard is actually seen by many as a bit of a problem, because it's making you go back and amend previous financial statements as a result of errors which were unforeseen at the time. And that leads me on to a very important point. The thing with these prior period errors is they have to be genuine errors. Now, in your notes on page 54, okay, you can see right near the top of the page there it says examples of such errors are mathematical errors, mistakes in applying an accounting policy, oversights or misinterpretation of facts, and or fraud. If you find a fraud during this year's sort of work, and that fraud has clearly been going on for some time, so we're going back a number of periods, then you would be required to go back and amend those financial statements from earlier periods, which obviously constitutes a prior period adjustment. If you have any mathematical errors, so for example the person who is responsible for sort of posting their debits and credits through to the nominal ledger, let's just say for example they made a mistake, and instead of posting 5 million they actually only posted 500,000, and it's during this year's work that somebody spots it. Well, you'd say, if that's material, I have no choice, but I have to go back and restate my previous year's financial statements. Again, highlighting to everybody that mistakes are happening in the organisation, and so therefore they're not seen as particularly sort of helpful. Now, going through the schedule of all of the delegates, I noticed that there's a number of you that work for sort of large accountancy firms, and those of you that work for those, I'm going to assume that you work potentially in the sort of audit department. By all means, correct me via email sort of afterwards. But for those of you out there that are auditors, adopting IFRS is actually quite tricky on some of your clients because of this whole idea of prior period adjustments. And so from a real world context, we have to be aware that as soon as you start adopting international standards, this whole idea of prior period adjustments as a result of material errors can cause audit fees to rise. They can also cause insurance premiums to rise. So real world implications on this little standard. Now, very important here that you remember that when we're looking at sort of prior period errors, it doesn't just mean you've had better information. Now, what I mean by that is under certain circumstances you may make, for example, a provision. So we'll see later on in the course that we'll be talking about provisions, and let's just say, for example, that I become aware of a legal claim against me, okay, and as a result I'm going to make a provision for 1 million currency units. Okay, we'll just use CU as currency units just to keep it sort of fairly generic, but I'm talking 1 million currency units, and that is based on all of the information that I have at that point in time. So at the year end, and let's just say the year end is 31st of December 2007, I make a provision in my accounts for 1 million currency units. Okay? Now, let's just say that during 2008, okay, we lose the case, and the judge makes an award of 2 million. So we're thinking that it's actually going to be just the 1 million, but it actually turns out that the judge is going to award 2 million to sort of the plaintiffs. Now, does that constitute an error at that last year? Again, let's just have a show of hands. How many of you think that that constitutes an error that I would need to go back and amend my financial statements? Anybody think that's an error? No? Excellent. It isn't an error. It's literally just a change in circumstances. So that would not constitute an error. And therefore, there would be no prior period adjustment. Okay? So, when dealing with prior period adjustments, we don't have to do it just when there's better information. It's only when there is an actual error that has been caused sort of by mathematical errors, accounting policy, sort of oversights or fraud. Okay. So, just to finish off on this particular chapter, and hopes that you're sort of up to date, what we've talked about so far, we're talking about sort of IAS 8. Okay. IAS 8 requires us to select accounting policies, okay, to give fair presentation. Okay. We must constantly review those policies to ensure they're still giving us fair presentation. Okay. So we still must have to review those policies to ensure they're still giving us fair presentation, and we would change as necessary. Okay. In addition to that, we saw that you have a change in policy when you have either new standards. Oh, someone's got mobile phones on. Okay, when you have sort of either a new standard, or alternatively, once you have sort of like a fair presentation issue. Okay, and we said that how do you determine all of that is when you look at recognition, presentation, and measurement. We then talked about estimation techniques, okay, which is purely what you're doing to ensure that sort of you're getting the right number, but it's the mechanics of arriving at the number rather than the basic underlying principles as to how you're accounting for things. We looked at prior period adjustments, and a prior period adjustments comes from a change in policy or a material error. Okay. And that basically takes us to the end of chapter 4, sort of on accounting policies, and we're doing very well. We're slightly ahead of schedule. We've done this so that it allows the other speakers that are going to be coming in so a little bit later on. So what I would like to do now is to give you the opportunity for sort of 5 minutes to ask any questions. Okay, perhaps Bangkok would like to go first. Are there any questions coming from sort of Bangkok? No questions there. Beijing? Are there any questions from Beijing? No? Hanoi? Jakarta?
Could you please explain a little bit about the materiality for errors for prior period adjustments?
Yep, certainly I can do that. Materiality is literally an amount that matters, and it really is defined that simply. Quite often it will be judged based on audit materiality. So, for example, if I gave you a suitcase full of money, Okay, and in there was sort of $1 million US. And I said to you, there is $1 million US in that suitcase. And then I left the room. And you started counting it, and you said, hang on a minute, there's $10 short. Would you mind? Probably not. $10, you'd think, well, I've got $1 million, so $10 short's not really a problem. What if it was $100 short? What if it was $1,000 short? In fact, what if you opened the suitcase and it was completely empty? Okay. So the difficulty here is, at what point does it begin to matter? Now, we get our guidance from at what point it begins to matter pretty much from auditors, because an audit is done on the grounds of materiality. So they'll undertake most of their work looking at material items. But items become material because they have an impact on the decisions made by users of financial statements. So the simple answer to your question on materiality is that there actually isn't a simple answer. It would be different for every single company. They quite often use guidance from percentages of revenues, percentages of net assets, percentages of profits, but every company is slightly different. So if you felt that it was a very risky company, the chances are you would use a much lower level of materiality to assess things. If it was a very risk-free company, you would set a higher level of materiality because you would think that there's going to be less involvement. You'd also look at the level of interest in those financial statements. So if it was a listed company, there'd be more interest, and so therefore you'd want a lower level of materiality. If it was a privately owned entity where the only people interested in the financial information were the owners, and they're just family members, then the chances are you would not be anywhere near as concerned, and so therefore materiality would be higher. But quite often we do refer back to auditors on what level of materiality that they would have assessed. Okay, does that answer your question?
So that's judgment, and that depends on each companies to decide, and that may be different from auditors' materiality, right?
You are right. It will depend on sort of many factors. Ultimately, the decision will be made predominantly by the auditors, if we're absolutely honest, because if a company says, oh, we found this error that relates to last year, but we don't think it's material, the auditors are going to turn around and say, well, actually, we do think it's material, and so if you don't do a prior period adjustment, we would qualify your financial statements. So whilst the company will decide what they consider to be material, ultimately it will go back to the auditors to make that final decision. Now that actually gives quite a lot of authority to the auditors in respect of this, which clearly isn't the point of the standard. The standard's not trying to do that. However, by default, it almost certainly will give a lot of authority to the auditors over what constitutes materiality. What we're probably going to start seeing is auditors communicating materiality to their clients. Certainly when I'm doing this year's audit, I will almost certainly as an auditor communicate last year's materiality to that client so that they're able to assess the level of materiality for the purpose of adjusting prior period errors. Okay, is there any other questions coming out of Jakarta?
Yes, I would like to ask about the legal case that you just put in as an example to differentiate whether it's a change in it's an estimate or not. In many cases, it's very hard to determine whether the difference between the provision and the actual result is related to any oversight or misinterpretation of facts. So, in your experience, do you have any situations when you feel that the outcome of the legal case could be considered as error and that needs to be
Yeah, in terms of sort of any level of provision, obviously when you're making a provision, it's your best estimate of the outcome. And there have been a number of circumstances where the decision as to what the best estimate is may be kind of applied or maybe arrived at with a little bit of bias involved. For example, if I think we're going to lose a case and I go to a lawyer and I say to the lawyer, okay, how do you think we're going to get on? Do you think we'll win? Well, obviously that lawyer is going to want the business from me to try and defend my case because that's how they earn their fees. So there's always been that question mark on how accurate lawyer assessments of the likelihood of winning and losing legal cases is concerned, and also the level of loss. I mean, for example, if you were talking to two different firms of lawyers to represent you in the case I suggested, where you've made a provision for 1 million, that will be based pretty much entirely on the legal advice that you've been given at the time. Well, if that lawyer is trying to win your business, and I'm talking to two lawyers, and one of them saying, yeah, well, I think we may lose this and it'll cost you $1 million, and the other one says, I think we can win this case and so therefore it won't cost you anything. Well, which firm of lawyers are you going to use? You're going to use the one that gives you the best result. And so therefore the paperwork that you would use to justify the actual provision is going to be slightly biased by the fact that the lawyers want to win the case. And certainly there's a lot of evidence that suggests that legal opinion varies as much as sort of what the weather's like in the different locations that we're talking to. So there is always that question mark about how reliable making provisions are, but it is purely an estimate. The only time it would give rise to a prior period adjustment is when you actually have a mistake that's been made. So, for example, the lawyer on their letter to confirm the balance has said to the auditors, yeah, it's only 1 million, but there was actually a typo and it should have said 7 million. In that case, you would say, well, actually, that was an error. It wasn't just a kind of an incorrect assessment. It was an error in the typing, so therefore you would go back and adjust the previous year's financial statements. Does that answer your question?
Yes, it's only in experience it's very usual to be very difficult to consider certain facts as not being an oversight of facts, because in page 54 in the material it said that an example of such error is oversight or misinterpretation of facts. But in legal case, in tax cases, usually the post fact or mostly could be considered as an oversight of facts.
I mean, that's kind of the issue. If there is an actual oversight and it is a genuine mistake, then you would do a prior period adjustment. If, however, it is just literally that the bank has just got the number wrong because of their estimation technique or the models that they're using to assess it, then that would just be a change in estimate. It wouldn't actually constitute a prior period adjustment. The question that you have really is to sort of identify whether it was a mistake or whether it was using the best information that was available at the time and it was a genuine best guess of the sort of the actual figures. If you felt that they had chosen a figure to be more favourable, then that would constitute sort of requiring a change in policy, because it would constitute a mistake. So if the one letter that actually says we're going to lose this case or you need to make an extra provision suddenly kind of like disappears and gets lost, then that would constitute a mistake. Amongst other things, it would also constitute an ethical issue, but you would go back and amend it. Okay, are there any other
could we
questions?
just ask if... Yes, it just that here in Vietnam, we can't hear what the... it's very soft what the questions are that are being asked, so if people could speak up, it would be good.
Okay, that's not a problem. I'll repeat the questions as well, just to make sure that everybody can hear it, so my apologies for that. Are there any other questions from sort of any of the other delegates?
I have a question, if possible.
In your analogy of this chicken and duck, I have this impression that there are differences in the application of substance over form between IFRS and US GAAP. Are there some examples?
Oh, that's the golden question. It's always a very difficult one. The question was relating to my example of chickens and ducks, about sort of whether there's any differences in understanding of substance over form between IFRS and US GAAP. The simple answer is yes, massive differences. US GAAP tends not to really recognise the idea of substance. US GAAP is very much legalistically based. It's very much tick the box to say, yes, we've done this, yes, we've done that. A classic example of this, whilst it's not actual GAAP, is something like Sarbanes-Oxley or SOX. That is very regimented and very rigorous. And most of US GAAP is actually following the same fundamental principle of ticking boxes. So significant weight under US GAAP would be to the paperwork and the documentation that was in place in terms of identifying whether it was a chicken or a duck. Under IFRS, we would actually take a big step back and just watch it and observe it and say, well, what does this look like? Now, a slightly better example than chickens and ducks would be, for example, my calculator. Okay? Let's say that I was going to sell my calculator to someone in the Philippines for, let's say, $5 million US. And I promised to buy the calculator back from the Philippines for $5,050,000 in a year's time. That doesn't sound like a genuine sale. It's a calculator, you can buy it for near to nothing. It's certainly not worth $5 million. I'd like it if it was worth $5 million, but unfortunately it's not. So that wouldn't constitute a sale, and under US GAAP you would actually still look at that and say, well, there's a document, there's an invoice, there is an option to repurchase, so we would account for that in that particular way, and therefore there would actually be an argument for treating it as a sale. Under IFRS, as we'll see sort of shortly when we move on to revenue, you would turn around and say, don't be silly, that's clearly not a sale of a calculator for $5 million. It's clearly a loan of $5 million and I'm paying $50,000 interest, and so therefore I would account for the $50,000 extra dollars as interest through my income statement. Okay. Is that okay?
Okay, I got one
Yes.
question. Assuming we made one material prior year adjustment, and on the face of financial statements, do we need to make the reconciliation between the opening balance and the restated balance on the face of financial statement?
Right, if you're doing a prior period adjustment, what you're doing is you're actually going back and changing the financial statements from the year before. So you would have to do a disclosure in there explaining the reason for that change and the value of that change. But the only disclosure you would do is, sort of as you saw in the illustration in the notes, at the top of the 2006 it just says 2006 as restated. Okay, so you'd have to put that on every column of numbers that you'd amended. Okay.
All right, thank you.
Excellent. Okay, do we have any more questions? Probably got time for one more.
Yes, can I ask one question, please?
Certainly.
Yeah, it's about the substance of reform you just discussed before. Before the IFRS, we used the US GAAP as our benchmark here. But as far as I know, that US GAAP based on contractual form. That's always teach by my lecturer when I was a student. That is the reliability and neutrality of the value is based on something real. There's a contract, but an economic substance is very shaky because everybody can put some value on it, and it's. I mean, there is no basic proof of whether the value is accurate or not. What do you say about that? Thank you.
If we're talking about making a provision, and we're saying that sort of in reality, you know, we are being sued, we're being sued for $5 million, and we've spoken to the lawyers and we've taken advice, and there is a kind of like a legal opinion that says we could probably lose this case and it'll cost us $5 million, it'll cost us $3 million. It could be 60% chance of costing $3 million, 20% chance of costing sort of $3.5 million, etc. There could be a whole variety of information. What we have to do is we have to, again, apply this principle of fair presentation. So you could perhaps use a weighted average of percentages to say, well, if there's a 60% chance of it being $3 million, 20% chance of it being $3.5 million, and 20% chance of us not losing the case at all, you may say, well, on balance, I think a provision of $3 million, because that is by far and away the most likely outcome, and therefore make that provision. So it's not so much that there is a contractual obligation to pay that money, it's more based on experience and kind of like an establishment of a fair value.